Welcome to the daily update, where I'll go over the action in the market for Wednesday, June 18th, and we'll see how things look for Friday, June 20th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. The markets will be closed on Thursday, so here we go. The Fed came out and didn't do anything, which was expected. Said some things, really didn't say anything all that new. They're just waiting, need more data. We had a positive start to the day, but we kind of fizzled out, turned around, came down, and by the time we closed, we're actually down a little bit. So right at the open, we had a flat open, which is fairly common. Prices were a little bit more aggressive than you might anticipate on a Fed day, but you've got a lot of buy the dippers that are trying to position themselves ahead of what they think is going to be a big move. Didn't really work out that way on Wednesday. But prices did rise and got a little bit above R1 at 6,012. So we were back above 6,000. That set the intraday high. So it was not too long after the open. Then we spent the rest of the day being at a lower price. We declined down to the daily pivot. We got down below 6,000. The daily pivot was at 59.93. Then things kind of just hung out for a while. Right after the announcement, there was some gyration. We were mostly gyrating above the daily pivot. And then as we got closer to the close, things dropped. We ended up going down below the daily pivot. We went down below the unchanged level and closed slightly negative on the day. So we were down just 0.03%. Now, it was a little bit more negative than positive because we were looking positive earlier. We gave up those gains, went all the way back down, and actually came in with a negative day. We still continue to be below average with volume. We're still positive, though, in the short, intermediate, and long term. I use the 20, 50, and 200 period moving averages to measure that, and price is still above all of those moving averages. And we're seeing some fluctuation here with interest rates. There's this concern coming out now that the economic reports that are being released are weaker than expected. There were some folks, now the market didn't think the Fed was going to do anything with rates. I go through a thing called the Fed Watch tool over the weekend, and that's what we pay attention to. You can hear opinions back and forth, positive, negative, when it applies to pretty much anything. But because the stock market gives off so much information, we can tell what the market is actually anticipating, and they were not anticipating a rate cut. And everything is pretty much surrounding geopolitical tensions right now. Israel, Iran, how is the U.S. going to become involved? If so, to what level? And that's really have some unsettling going on right now. We saw a lot of additional hedging at Wednesday's session because the market is closed for Thursday. And we'll see, is that going to ignite any kind of protest domestically? And then things are changing quickly in the geopolitical situation. So folks just want to be prepared in case that happens. All right, some comments. President Trump said that there's still time for Iran to negotiate, but he's pretty clear when he says Iran cannot have a nuclear weapon. And so he says that later this week or next week will be big. So that's very open-ended right now. Whether it's going to have U.S. involvement or not, is the U.S., which is an ally of Israel, are we just going to support something that Israel is doing? Then, as expected, the Fed didn't change rates. They're still at 4.25% to 4.5%. Then they come out with this report called the SEP. Okay, and it showed the median estimate for 2 rate cuts before the end of the year. All right, so the market kind of liked that at least a little bit to begin with. But this was the same reading. It didn't get changed from the last time we saw this at the March meeting. But there was an increase in inflation. And that's kind of the overall scenario that the Fed has been concerned about, that inflation is going to go up. Where it had been at 2.7%, now they're coming in saying that inflation could be at 3%. And then the core PCE inflation could go from 2.8% up to 3.1%. GDP is getting lowered. So we're seeing growth being revised down and inflation being revised up. That's not very positive. And then the median estimate for unemployment, it is up to 4.5% from 4.4%. Currently, we're at 4.2% with the unemployment rate. Then during Chair Powell's press conference, he stated that uncertainty remains elevated. That's kind of what they've been saying all along here. The Fed needs more time. They've been saying that too. And to see what is the Fed going to do next? He also expressed an expectation for some meaningful inflation in the coming months on the account of tariffs. Now, we're not seeing that necessarily reflected in the economic reports that are coming out, but that's what he's anticipating. So this was taken as a bit more negative, but not necessarily anything really new. Oil, we're still up into the mid 70s now at 73.56 per barrel. We're still above 20. We came down a little bit with the VIX, but we are at 20.14. Another thing that's kind of more negative now, I pointed this out in yesterday's video. Apparently, we had enough of a decline and the lack of a high. So now the parabolic SAR, that's a primary indicator, has now turned negative. I'll show you that later. We still have our stochastics looking extreme positive, and the slope oscillator is extreme positive. Intermediate term, we're pretty much turning over to negative now with our momentum oscillators, but the PMO is still giving an extreme positive reading. And there are other ones, especially the long-term oscillators, the KST and the tricks. Those are long-term, and they're rolling over and turning negative, but they're still extreme positive when you look at them on the chart. And then the Stoch RSI is on the list still here as being extreme negative already. Then no change to they really didn't say enough. They pretty much came out at the Fed and are pretty much taking the same stance that they've been looking at before, where they're concerned about economic growth going down and interest rates having to go up maybe because of inflation. Then the dollar was up, interest rates were down. We're at 4.4%. We just ticked up one notch there. It was kind of a wild day with not much of a change by the time we closed, kind of like what happened with the S&P. Sentiment is neutral, where we're at 54 right now with that reading, and we're still not trending. We're positive because the green line's above the red line, but we continue to drift lower with the ADX, and we're below its moving average. And I'm still keeping the bias at negative because mainly Tuesday's session was negative, even though we were virtually unchanged. And the momentum right now is mixed because we're just chopping along in a trendless environment. All right, so we did get this finally became a little bit more clear because usually it's Thursday when initial jobless claims and continuing claims come out. We got that a day early. They came in pretty much not too far from expected. So we're not seeing a big change there like we were a little bit concerned last week. And jobless claims still, the continuing claims at 1.945 million. Housing starts, this is weaker than expected, minus 9.8%. That's month over month. You seasonally adjust that on an annual basis. It's 1.256 million units. That's less than what was expected. Building permits also declined on a month over month basis and came in at an annual rate weaker than expected. So here are the chart of the jobless claims where we were concerned that we're going up. Now the 4-week moving average is still going up, but we did come down from the latest reading. And continuing claims also still going up, but dropping down just a little bit from the previous reading. This puts it all together with the current unemployment rate at 4.2%. We have the initial claims in red, the continuing claims in blue, just to kind of give it a little bit more context. Then housing starts and building permits, we're seeing a decline with both. The blue line are the housing starts, the yellow line are the building permits. That's showing some weakness there. We're also declining with the housing starts with this chart. And then we saw a decline in the mortgage applications for the week as well. That ended up being down. Okay, now this is a little bit different chart. It's kind of the same thing that we talk about quite a bit, but when we look at the forward and trailing operating earnings per share, where I look at a historic and then forward-looking PE ratio, so this is kind of similar to what we see here, but putting them pretty much right on top of each other here, and where the forward estimates are a little bit lower than the trailing estimates based on the PE ratio here. So we're seeing a little bit of a disconnect, but that's not, we usually see the black line below the red line, but they are going up in the latest readings. Then when we don't get rate cuts in 2025, but two or more in 2026, this is just what FundStrat is anticipating here. And we don't really know based on, and this came out before the Fed made their announcement and came out with their SEP report. But again, this is something that people speculate on because we're not even quite halfway through 2025 yet. Of course, you can kick the can down the road and say, yeah, maybe in the fall, maybe in the winter. And then we'll finally get to that period of time, and then things will be adjusted to reflect that. Discretionary versus the systematic equity positioning, as I explain every time, discretionary, that's the green line. That means you can choose when to get in or get out. You use some discretion there. Where the systematic approach, that just means you're invested in the market all the time. You're not really concerned whether the market's going up or down. You just stay in the market. And when we've been really choppy like we've been in 2025 with the decline, the systematic approach tends to underperform the discretionary because people say, hey, let's have problems, let's get out for a while, where the systematic person would just stay in during that time. Then we've been seeing a lot of this lately where this is a little bit different, where we're looking at the households that actually have some share of equities, and it's about 49% in the US. And then you can see other countries don't have quite as much on the line when it comes to the stock market. The fund flows, where they changed the color here. Usually tech is yellow, but on this one they changed it to blue. That's still where we're seeing most of the money coming in, and that's a growth area, and people are still at least somewhat positive that that growth area is going to kick into gear. And it's still holding up for right now. We're just not trending, and the market is having a difficult time being convinced of, do we want to have more conviction to the upside or the downside? Then the financial conditions index, this has been dropping off, and it's also dropping off when you take out equities. So this could actually be more positive, because when we see the financial conditions loosen, that tends to help the market. Then risk on, risk is on. Okay, here. This is, and I look at a variation of this over the weekend when we do a stock to bond ratio. And this chart is still holding up on the chart that I look at, and it's still looking pretty positive right here. Then margin debt, when the market's more positive, folks are willing to borrow money from their broker to be able to buy additional stock. It's currently at 50%. So if you have $10,000 in an account, that gives you $20,000 of buying power. When this really starts to drop, we saw it earlier on as we were dropping in late March and into April, but it's still looking pretty solid. We'll actually get the official number because June is the end of the quarter, and that's when they end up adjusting it. And this is Goldman Sachs chart. It's FINRA that usually calculates the margin debt. Then, since we had retail sales, we are still kind of leveling off here. We did decline in the latest reading with this, but we just want to be aware of that, because before we go into a recession, a lot of times we see a real flattening of this chart of retail sales. Now, we did flatten a little bit. Of course, COVID, that was its own thing, but we've been fairly flat here, but we're not necessarily really falling apart. And then about the time, if we do go into a recession, that's when we see retail sales really starting to drop off. And economic data, it's getting bad. We've been seeing weaker than expected data coming in here as measured by this chart. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. All right, so we had a flat open, but then the folks that usually begin things at the start of the day, they saw some buying coming in. Took us above the daily pivot, above R1. Then we just topped out right here, drifted all the way back down to the daily pivot, and then the Fed came out with their announcement. We gyrated a little bit up, gyrated back down, but most of this gyration was above the daily pivot. Then later on, we dropped down. It was a pretty big move down here where this actually took us negative, and then we gyrated below the daily pivot and then closed just a little bit negative on the day. And then things are pretty quiet right now since the market will be closed on Thursday. The futures are just pretty much unchanged from the close on Wednesday. Still looking okay here, even though the blue line and the red line are declining. We still see the blue line above the red line. That means large cap growth is outperforming large cap value intraday. Still holding up fairly well when we look at S&P growth to value intraday. End of day growth was down where value was up, but not very big moves here. A little bit less for the mid caps and quite a bit less, about half as much for the small caps. So seeing a little bit of a drop off here with our small cap growth to value ratio, but still this is holding up. Mid cap growth to value also holding up, showed a bit of an improvement there. Just kind of waffling around, but above the moving averages when we compare large cap growth to value for the S&P. Still holding up with this growth to value ratio that we take with these ETFs. And still hanging out around the 200-day moving average with the equal weight version of the discretionary to staples ratio. Still holding up fairly well with our high beta to low beta ratio. This continues to go up. It was up a little bit more than 0.5%. So that's more positive when this ratio is going up. Not trending. Short term, declining, below the moving average, below 20. Positive because the green line is above the red line. Now, if we cross here, but we've been close before and it didn't quite happen, but if we cross, that's going to turn the overall bigger picture to negative. Also declining with the green line below 20, below the moving average, and just not trending right now. Below average with volume here, also continuing to be below average here. We did decline with the VIX, but we're still above 20. Both with the line chart and the bar chart. Came down just a little bit, but we're still above the moving averages with the VIX of the VIX. That just shows that the VIX, the volatility of the VIX itself decreased a little bit. We're still seeing the momentum for the VIX starting to go up. I didn't show this chart as the MACD was going flat, but now that this is showing a little bit more conviction as the VIX has been going up, I've been including this chart again. We ticked down a little bit, but we're still in this red area with the skew index. That means the market is still expecting some kind of a big move. We don't know if it's an up move or a down move, but there is some positioning going on using out of the money options to gauge that they think it's either going to be an up or down move. We declined a little bit with this fear gauge, where we went up with the other fear gauge. So again, some contradiction there. Still looking okay with the risk on to risk off ratio. It's still going up, and that's positive. And saw a massive, just huge amount of hedging with more puts. When this goes up, that means more puts are being purchased than calls. So that really went up. So it's causing our 5-day chart to really advance and the 10-day. Now, this tends to be more negative. Again, as I said, it could be just some hedging ahead of Thursday's close to market. And bit of an increase here with the volatility risk premium back above the band. So we're seeing some fear coming back in the market that we hadn't been seeing as much of over the last few trading sessions. But with the escalation of geopolitical events, yeah, that's not surprising. Advanced decline lines showing a little bit of weakness based on price, actually advanced a little bit based on volume, but still holding up okay overall. We ticked up, but we're still below zero with the advanced decline oscillator. And we're dropping a little bit further below zero here with the advanced decline ratio in the short term. We're declining, but still positive with the intermediate term advanced decline ratio. And still going down with the 5-day and 10-day moving average of the new highs minus the new lows. Just kind of drifting here. We're still seeing more green than red, but we're seeing more of a contraction of the green, which are new highs. This is actually turning more negative. We're coming down to the moving average now with the accumulation distribution, and the boom indicator is declining. Now, technically, this is still positive since we're above the moving average. It won't turn negative unless we drop below the moving average. But here, smart money indicator number 2 continues to decline. The red line's going down. The histogram is declining. We're actually dropping below the midpoint with Chaikin oscillator. So that's looking more negative. And we ticked up just a little bit. You can't really see it because there's a line here, but we're still positive with the vortex with the green line above the red line. And still above the moving averages with our advanced decline line studies. The only one that's kind of close are the small caps, and even they bounced up off of it a little bit. Still below 50 with those stocks in the S&P above their 20-period moving average. Declining, but still positive since we're above 50 with the 50-period moving average study. Ticked up a notch here with the 100-period moving average study. We're also still above 50 here, but we continue to decline below 50 with those stocks above their 200-day moving average. And here we're seeing this looking a little bit more vulnerable now. As I've been trying to point out, we saw a series of higher highs and higher lows for the most part. But then we came up and we hit this pivot point, this dashed line here. That's overhead resistance. We have not been able to get back above that. And now we're starting to show a little bit more weakness as we're coming down and starting to break the pattern of these higher lows that we had been seeing. And then on the bottom, we're still below average with volume. We ticked up a little bit, but we're still below 50 with the 20-period moving average study. We're above 50 with the 50, and we declined a little bit here to flat with the 200-period moving average study for the S&P. Still extreme down here with the Stochk RSI. That's already extreme negative. That's showing more negative action right now, where we're still above the midpoint with the Williams percent R, but we have been declining and above the midpoint with the CCI 14, and this is a little slower, so it's declining and above the midpoint with the CCI 20. Coming down here, looking more negative with the short-term stochastic, also declining with the intermediate term, still extreme positive, but rolling over. We're above this green line here, but below the moving average with the long short-term stochastic. Just hanging on to right about at the midpoint with the force index, seeing a little bit more vulnerability with the short-term trend based on 20 periods. We haven't been able to get back above these lines, so now the green line and the blue line are starting to roll over. Still in the +1 channel with our standard deviations chart and above the midpoint. So that's hanging on to being positive for right now. Balance of power actually ticked up a little bit, and we're still above 0. That's still positive. And we've spent the last couple of days now below the 10-period simple moving average, so now it's starting to flatten out where it had been climbing after we saw this previous period of flattening out. And the go, no go still has this positive with darker blue bars. And we're still above the midpoint with the highest high value chart. Still looking positive with the Landry Light trending system and the proper order trending system. Those are hanging on to being positive. TTM squeeze was improving. It was turning a lighter shade of blue. Well, after Wednesday, it's now turning to a darker shade of blue, and that's more negative. And then this goes back, this is measuring the climb that we saw out of the lows in April. That's why we're getting such a high reading with the rate of change based on 50 periods. Still hanging out just slightly above 0 with the ease of movement. That's really not showing any conviction. Declining a little bit, but still positive with the oscillator for the Arun indicator. Ticking up a little bit with the S&P McClellan oscillator, but we're still below 0 overall. So this is still taken as negative. And when the McClellan oscillator is below 0, the summation index declines based on price. We're also declining based on volume. We ticked up, but still below 0 with the NYSE McClellan oscillator. So coming down with the summation index based on price and volume for the NYSE. Still negative here with the Swindler trading oscillator, declining based on price and volume. Rolling over below the moving average with the PMO, but we're still above this red line. That's why we're extreme positive. But we are showing more weakness when we break it out based on price and starting to fall down below the moving average based on volume. And didn't quite get to an extreme negative reading yet with the PMOs that are rising, but the buy signals are declining and we're starting to drift down with the PMOs above 0. Neutral with the Elder's Impulse system. Negative now with the parabolic SAR. We saw enough of a decline here to put a dot on top. So that's turning this primary indicator now negative. Still trying to go up with the slope oscillator, and it's extreme positive since it's above the green line, but we're drifting lower with the MACD, that's negative. So the slope's going up, but our other short-term oscillator, the TSI, that's crossing below its moving average, so that's negative. So we're getting a mixed picture in the short term, where it's turning more negative here in the intermediate term with the MACD, PMO, and PPO. We're also turning negative and still extreme positive with the TRIX and KST. This is a bit of a concern as well. We were trying to cross over positive with the Copic curve momentum oscillator, but now we're starting to turn back below the red line. Declining, but right on the border between being more neutral than being positive here with the Sean trend meter. Declining, but still above 50 with the money flow. Also declining, but above 50 with the ultimate oscillator. Still positive with on balance volume. Still above 50 with the intermediate term RSI and the short term RSI. And seeing a little bit of vulnerability coming in. We've spent 4 trading days now below this red line. The longer we stay down here, the more this red line may roll over. The intermediate term trend had been hanging in there quite well as we were going up. Now that could come into some doubt if we stay underneath the red line. We're still above all the plotted moving averages. We're still watching the 20 period. If we break below these previous lows, we're going to be watching to see if that provides support. We're negative with the bullish percent index. We're below the moving average and declining. And we're coming down with the NYSE bullish percent index. I still have it on the positive list because we're above 50. I don't do the studies on this chart that I do on the S&P one. And we're no longer extreme positive with the bullish percent index for the NASDAQ 100. And that is now starting to look like it's getting to decline more. We're still holding on to the 20 period simple moving average of the high. That's still providing some overhead, or actually support underneath current price. And just kind of hanging out here around the midpoint with the 150 and 200 period moving average studies. So we're looking a little more negative with the Heikin Ashi. We're positive but pointing down still with the Kagi chart. Still positive with the Renko chart, but we're turning more negative with the 3-line break chart. So again, a mixed picture there. We're still holding on okay with the weekly chart of the S&P. Now we only have 1 trading day left, and so far we're up 0.07% for the week. So if we're able to be flat or up on Friday, that would give us an up week in Friday's session. No change here. Still negative in the long term with the mid caps and small caps. Bonds are positive in the short term based on price. Commodities have now switched to positive across all time frames, where the dollar is negative across all time frames. And we saw utilities, real estate doing about the best, but see, nothing was really up all that much. Where we had energy, which has been doing quite well lately, but bigger picture, it's still negative. It was the worst performing sector. So we did have Canada setting another new all-time high, and then the NASDAQ did go below 19.5. We got below 6,000 with the S&P. Now, we saw a BPI cross below 80 with the tech sector yesterday. Now we're seeing a BPI cross back above 80. The euro's been doing really well compared to the dollar, and then the NASDAQ was able to bounce back up later in the day and get back above 19.6. So the areas over here like tech, these are green for the most part, the bigger stocks, and they have more of an impact on the index, where Amazon was down, Tesla was up, and then in communication, we had both Google and Meta down, so that dragged that down a little bit there. Still below the 200-day moving average with the Dow, and notice how we came right up to the 200-day moving average, and this is back to providing overhead resistance. We are negative with the Elder's Impulse system for the diamonds, seeing a little drifting down, a little bit more vulnerability to this chart pattern for the NASDAQ. Same thing we're seeing with the S&P 500. We're neutral with the NASDAQ with the Elder's Impulse system. Also now drifting a bit lower here, even though the NASDAQ 100 was unchanged on the day. It's still showing some weakness. Now, we're still above both of these moving averages. So as long as we stay up here, we might end up seeing a golden cross. We're neutral with the Elder's Impulse system for the Qs, but the momentum for the NASDAQ 100 is negative as the PPO is declining. And we were up 0.4% with the small caps, but they really haven't gone anywhere. and also up a little over 0.5% here with the Russell 2000 small caps. It's positive in that we're still able to see the RSI maintaining most of its recent price above 50, but we're negative with the momentum as measured by the MACD for the small caps. Negative to neutral with the small caps, so that's an improvement there. Just kind of chopping along sideways with the mid caps, still negative with the Elder's Impulse system for the mid caps. Kind of chopping along above both of the moving averages with the Wilshire 5000 and the total US stock ETF. We were virtually unchanged, but down slightly with the financial sector. We're still keeping an eye on the ratio. The sector is maintaining itself on a ratio basis when compared to the S&P. So this support is still holding for now. And the FANG index, it was down 1/3%, starting to flatten out now, but this has been one of the better performing areas, and these are the really big stocks. Apple was up almost 0.5%, and we had Amazon down over 1%. Microsoft was up 0.46%. It had an okay day there on a comparative basis. Google was down almost 1.5%. Meta was down 0.21%. Nvidia was up 0.94%. It helped things hold up fairly well there. And Tesla was up 1.8%, but it's been really chopping around, but it's above both of the moving averages for right now. Netflix was up, but not back to setting new all-time highs, at least yet. We're still tending to decline when we look at the staples to tech ratio, and this ratio going down is positive for the market. Still seeing more weakness here in the short term between US and world stocks, where the longer term correlation continues to slowly get stronger. And oil back up into the mid 70s now. That's more geopolitical. And the dollar, even though it was up here, it's still fighting a pretty severe downtrend. And we're at 2.12% with the Truflation read on inflation. So that's actually going up. We're still below 4.5% with the 10-year yield. That's the red line that you see here. And we're starting to break out a little bit above the 50-day moving average with the 10-year based on price. Holding up okay with the Q to S&P ratio and the large cap growth to large cap value ratio, but we're not looking very good with discretionary to the S&P ratio. So still hanging out around the moving average with the large caps, looking better with the mid caps, and actually declined, but still above the moving average with the small caps. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. So what's the outlook for Friday? Again, the markets will be closed on Thursday. It's also, now it's really triple witching, but they added another product called single stock futures 20 years ago or something, but those never really took off in popularity, and now those options expire as well. So really it's triple witching. So that could make for some gyration in the markets. And then at the end of June is going to be the end of the quarter, and that could also make for some gyrations as well. We're still positive, but we're not trending. There's been no change to this overall conclusion yet. We will get the Philadelphia Fed index and the leading economic indicator. It will come out on Friday. And then anything geopolitical that may happen, either positive or negative. Here's another look at the economic calendar for the week. And again, we'll be closed on Thursday. See how where they have initial jobless claims here? They ended up coming out on Wednesday. All right, seasonality, we're neutral to negative with the Dow, neutral to positive with the S&P, and neutral to negative with the NASDAQ. So no real clear cut. There's not a lot of conviction there, but we are dealing with options expiration week where we tend to be up 55% of the time and down 45% of the time. And we see a little bit more weakness here during a post-election year from a seasonal perspective. That's the green dashed line, where this may go down into early next week before we see a little bit of a bounce on a seasonal basis going into the end of June. So our smart money indicators are still negative, as is the discretionary to staples ratio on a trending basis, but we're still hanging out above the 200-day moving average. The S&P and NYSE McClellan oscillators and summation indexes are negative and declining, where the bullish percent index, it's now more negative, where I'm still keeping the NYSE and NASDAQ 100 one positive for now. The oscillators that we use, they are drifting and turning more negative, except for the slope oscillator. It wants to party right now, where the other ones are a little more tame and actually declining. The copy curve is still negative, with the swollen trading oscillator, and the longer-term special K chart is negative, as well as the momentum for the NASDAQ 100. Oh, that's nice. Okay, so on the positive side, we did generate a recent golden cross with the growth to value ratio for the S&P. And because they're above 50, I still have the bullish percent indexes for the NASDAQ 100, and the NYSE is positive. And, oh, this should be off of here. The parabolic SAR is actually negative. So that should be on, that's probably why this was messed up a little bit here. But the ease of movement just hanging out around zero, but slightly positive. The money flow, ultimate oscillator, and vortex, all of these are declining, but they're still positive. And the financial sector is positive for now. And here are the pivot points for Friday's session. It has it calculated for June. It doesn't realize on the software that Thursday's going to be closed. So our conclusion, there's been no change here. Positive, since we're above the moving averages, but we're not trending right now. Thank you. Have a really good day away from the stock markets if you get that day off of work. And I will talk to you in the next video, which will be after Friday's session, which will be for Monday's video.